And joining us now, Chief Economist with the Farmers Business Network, Kevin McNew. Kevin, great to catch up with you again, sir. How are you?
I'm doing great. How are you, Jesse?
I am fantastic. I appreciate the time today, Kevin. Let's jump right in. A couple new reports out from FBN. Let's talk the 2022 corn and soybean yield report. I know you guys released your yield report here just before the August WASDE from USDA. I want to talk about your guys' report, though. What did we find for corn yield and soybean yield here nationwide? What are you guys seeing after your report?
Yeah, I mean, our number is certainly different from what USDA threw down on Friday. And I will caution listeners that USDA's data, well, they're doing the best they can. It's not always a really good, accurate estimate of final yields. In fact, there's a lot of analysts, including ourselves, that have a better track record in recent years at hitting the final numbers when you compare it to what USDA throws down in August. So, yeah, I think the trade got a little spooked this morning. We're seeing the results of that. They didn't get a yield reduction on corn. We certainly think there's room to go to the downside on corn. We think there's some risk in the Western Corn Belt where there's been quite a bit of heat, especially. And so we use a lot of satellite imagery. And the other thing we do is really kind of zone in on acres that are really corn acres. We do that in season forecasting of pixels on the ground, if you will, that are truly corn acres. And so we get pretty granular in our forecast. So we're still on the low side. We think there's risk to go closer to 170 than 175 today, but we'll see what time says.
Well, and I know as well some of the findings you mentioned that dry Western Corn Belt. I know your report yields at Iowa, Nebraska, expected to be significantly below some of the strong yields we saw in 2021. Of course, you think Iowa. I mean, Iowa holds up a lot of our national average for corn yields, typically in a normal year, Kevin.
Yeah, that's actually that's really true. I mean, Iowa clearly the stalwart of corn production, but even into Minnesota, Nebraska as well. So the three of the four key states I think are let's call them question marks for the time being, and certainly corn conditions. If you look at Iowa corn conditions this year, they look pretty good, but I will again kind of when we look at the data, corn conditions this time of year are not very good indicators of final yield. So they can look good as you kind of drive by, and so we're getting good corn conditions, but extreme heat I think could potentially lead to some fill problems as we get closer to harvest. So you're right, our Iowa yields a little bit lower. Minnesota was another state where we're quite a bit lower than USDA, and again I attribute that to some of the extreme heat and dryness, especially in the western part of Iowa.
Well, and I know as well, in the Northern Plains, we saw late planting up there, but things looking fairly good across the Northern Plains. So that may be an area where we could see some yields increase for quarter beans. It sounded like from your report, Kevin. But we take a stock overall of everything. If we do see these declining yields, that's going to tighten up the balance sheet. And I wonder what that would do for markets moving forward. I think again, there's just a few question marks out there right now.
Yeah, I mean, in normal years, Jesse, I think we worry a lot about the minutia of U.S. corn yield and kind of we get really hyper focused as a trade. What I want farmers to take away is this is a much different environment. We are in an inflationary environment. I know the inflation trade has kind of eased off in the last 3 to 4 months, but I don't think that story's over. I don't think we're not anywhere close to normal. I don't think we're going to normalize anytime soon. I think as we get into 2023 and producers start looking at 2023, we're going to see high fertilizer prices. We're going to see a lot of things that I think are going to change the dynamic. So, the bottom line, as I see it, is we have inflation that is kind of demand side driven in agriculture. We also have supply issues with Ukraine not being a major powerhouse in agricultural supply. So I know the trade wants to get excited that one boat or two boats left a port a couple of weeks ago, but that's well shy of what we need. And I don't think we're going to see Ukraine back anytime soon, even if this war were to normalize and relations were to normalize. There's a lot of long-term logistics and capital destruction that's happened in that country. And so you're talking about, number four, top five major producer that is really handicapped for, I'd say, at least 3 to 5 years. And I think that keeps a floor into markets.
Kevin, let's talk another report from FBN here in the last week, Farmland Values Report. Talk to us about this and some of the results that you guys found in this report, Kevin.
Yeah, I mean, I think, farmland values went up sharply this last year, and we were certainly expecting that. We talk in this report about how there's kind of two key indicators that we track that really kind of give us a signal on farmland values. One of them is kind of profitability on the farm. Not surprising. We call it kind of a cumulative net farm income over successive years. And net farm income over the last couple of years has been pretty solid, and so that's translating into growth in farmland values. The other thing, and I think this is more important as we think about today, is what we call the real interest rate, real mortgage rate. And that's because it takes into account inflation. And, everyone's talking about inflation and, oh my gosh, this is like the 1980s. And, as someone who was alive and well in the 1980s, I remember inflation. I remember skyrocketing interest rates. But what we show in this report is that until you get interest rates that are well above inflation, then you don't really start to choke down farmland values. And so a lot of people will think about the 1980s and how farmland values really went soft and really, there was really hard times in the 1980s. And we talk about in this report how this is not the 1980s. Some of it due to what I just mentioned just here a second ago, is that we have a really strong demand side story, and we have constraints in agriculture that I think are going to lead us to be, seeing higher values. But then secondly, inflation is high and interest rates are still relatively low. So we're not in that paradigm we were in the 80s, when in the 80s we saw interest rates really skyrocket above inflation rates. And we're a long way from there. So I feel positive about farmland values going forward. Maybe not as strong growth in the coming years we saw last year, but certainly positive growth, and certainly no reason to be alarmed about farmland values going lower.
Well, Kevin, great stuff. Before we let you go, any other final thoughts about either report or anything in general with the markets and the farm economy you want to mention today?
Yeah, I remain so optimistic, and especially for U.S. Canadian agriculture. North American agriculture is so well situated. Some of it is because of our fertilizer abilities. As we look at the world today and all the problems that are going on in natural gas and fertilizer, the U.S. and Canada are so well positioned as it comes to fertilizer. We are pretty self-sufficient in our fertilizer needs. That's not to say we won't have high values for fertilizer, because it's a global market. But in the years to come, I think fertilizer is going to be a big constraint for example, South America, for example, Europe. Places that have not had to worry about fertilizer. And so I think this is a much different paradigm going forward. And I think North American agriculture is well positioned.
Well, I know if producers want to learn more, they can read both the recent reports from Farmers Business Network online, FBN.com. With that, Kevin McNew, Chief Economist with Farmers Business Network. Always a pleasure, sir. Thanks for joining us, and we'll talk to you again soon.
Thank you, Jesse.